Hi, my name is Dr. Annette Moultrie, and this is Accounting 101. So, let's see what we will teach in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Click on the notification bell so you'll be notified of upcoming videos. Also, please share this video. Welcome back. This is part 3 of chapter 3. We're continuing our discussion, chapter 3, the adjusting process. This is part 3. So in this video, we will continue with explaining what are deferred revenues, unearned revenues, accrued expenses, accrued revenues. So deferred revenues occur when a company receives cash from a customer prior to performing services or delivering a product. For example, an attorney requires a new client to pay a retainer fee of $1,000. Yet, the attorney has not provided the services yet. So the attorney would debit cash and credit unearned revenue to establish the liability. Now, if the client decides to not use the attorney, he or she can request a refund. Upon performance of the service, the revenue will be recognized. Deferred revenues, also called unearned revenues, arise when a business collects cash before earning the revenue. Deferred revenues are liabilities because the business that receives the cash owes the customer goods or services to be delivered later. When a business receives cash in advance of providing services, a liability can be created. As an example, a law firm engages Smart Touch Learning to provide monthly e-learning services, agreeing to pay $600 in advance. So the company Smart Touch Learning received the $600 on December 21st for the services to be provided in the next 30 days. Smart Touch Learning records the entry shown on the slide that you see here, recognizing the liability and deferring the recognition of the revenue. So there's a debit to cash and a credit to unearned revenue. And the explanation is collected cash for future services. On December 21st, a law firm engages Smart Touch Learning to provide e-learning services for the next 30 days, paying $600 in advance. So cash is debited for $600 and unearned revenue is credited for $600. The explanation is collected cash for future services. During the last 10 days of the month, that's December 22nd through December 31st, Smart Touch Learning will earn approximately one-third of the $600 or $200. So that's 10 days divided by 30 days. Okay. Therefore, Smart Touch Learning makes an adjusting entry to record earning $200 of revenue. So unearned revenue is debited for $200 and service revenue is credited for $200. So this adjusting entry shifts $200 from the liability account to the revenue account. Service revenue increases by $200 and unearned revenue decreases by $200. Now, had the adjusting entry not been made, the liability on earned revenue would be overstated and service revenue would be understated. Now, businesses often incur expenses prior to paying for them. An accrued expense hasn't been paid for yet, right? So a great example is salaries expense. Now, we know that employees, they work for a period of time before the business pays them for their time. We know that. So this type of example of receiving a service prior to providing a payment is accrued expenses. Accrued expenses are expenses a business has incurred but has not yet paid. Examples of accrued expenses are salaries expense, interest expense, and utilities expense. Assume that Smart Touch Learning normally pays its employee a month's salary of $2,400. That's not a lot, but we can just use this as an example. Smart Touch Learning typically pays half the salary on the 15th of the month and the remainder on the first day of the next month. So in the calendar, you see December 15th and January 1st are labeled as paydays. December 15th and January 1st are labeled as paydays. During December, the company paid the first half month salary on Thursday, December 15th. So the entry that is made is a debit to salaries expense and a credit to cash for the $1,200. The December 15th entry records only the first half of the December salaries expense. The second payment of $1,200 will occur on January 1st. However, the expense was incurred in December, right? So the expense must be recorded in December. The adjusting entry to record salaries accrued during the month of December is a debit to salaries expense and a credit to salaries payable of $1,200. And how did we arrive at $1,200? That's taking the monthly salary of $2,400 divided by the 2 pay periods. The accrual is necessary because the company has incurred the expense since the employee performed the work. Okay, so when the payment is made on January 1st, the salaries payable account will be debited, effectively eliminating the liability, and cash will be credited. Now, this is an example of a liability that was understated before the adjusting entry was made. It also is an example of the matching principle. Remember, we discussed the matching principle. So we are recording December salaries expense in December, so it will be reported on the same income statement as December's revenues. Now, I don't want you to confuse this entry with an adjusting entry, okay? Adjusting entries are recorded only at the end of the accounting period and are used to record either a revenue earned or expenses incurred, okay? So don't get it confused with an adjusting entry. This entry is a journal entry. It's a journal entry. It is simply recording an everyday expense, everyday business transaction, okay? The payment of salaries previously accrued. So in this example, the amount paid for salaries was equal to the amount of the liability in the adjusting entry. Salaries payable is debited for $1,200. Cash is credited for $1,200. Now, companies often borrow money for purchase of equipment or buildings, right? So the interest on the loan could be paid monthly, quarterly, or it could be paid annually. However, regardless of when the interest expense is actually paid, a business must accrue. They must accrue the interest expense owed, but not yet paid each month. The entry to record accrued interest is a debit to interest expense and a credit to interest payable. When the interest is paid, interest payable will be debited and cash will be credited. Here you see in this example, on December 1st, Smart Touch Learning purchased a $60,000 building in exchange for a 1-year loan. Building was debited for $60,000 and notes payable was credited for the same amount. The interest on the $60,000 note is payable 1 year after it is taken out. Although the company won't make interest payments for a year, the company must record the amount of interest expense that has been incurred by December 31st, 2024. The company will make an adjusting entry to record interest expense for 1 month. That's December 1st through December 31st. In the formula, the time period, okay, it represents a portion of a year that interest has accrued on the note. It may be expressed as a fraction of a year in months, which is the number of months divided by 12, or a fraction of a year in days, which is the number of days divided by 365. Now, this keeps the units for interest and time the same. The note payable has an interest rate of 2% per year, so the time accrued is expressed as 1/12 of a year. Here we see in this example, December 31st, interest expense was debited for $100. Interest payable was credited for $100. So that's the principal, which is $60,000, times the interest rate, which is 2%, divided by 1/12, meaning the 12 months. And that's how you would arrive at $100. The adjusting entry records a credit to the liability, which is interest payable. Now, this is because the interest payment will not be made until next year. Therefore, Smart Touch Learning owes interest to the bank. Now, had the adjusting entry not been recorded, liabilities and expenses would have been understated. So the entry on December 31st in interest payable account is interconnected to the December 31st in interest expense account. So next we're going to talk about accrued revenues. Accrued revenue occurs when the company earns revenue, and it's usually as a result of performing services or delivering products to a customer before receiving payment. So if the revenue has been earned, it is recorded even if payment has not been received from the customer. Accrued revenue entries generally require a debit to the customer's accounts receivable and a credit to a revenue account. Smart Touch Learning is hired on December 15th to perform e-learning services beginning on December 16th. This is an example that you're seeing right now. So under this agreement, the business will earn $1,600 per month and receive payment on January 15th. Okay. At the date of hiring, Smart Touch Learning does not record a journal entry because revenue has not yet been earned. Okay. During December, it will earn half a month's fee of $800 for work during December 16th through December 31st. So accounts receivable is debited and service revenue is credited. That's the journal entry. The adjusting entry records the earned revenue and brings the balance of the service revenue account to $17,500. In addition, the adjusting entry records an additional $800 account receivable. Smart Touch Learning did not record cash because the business has not yet received payment on the services provided. The cash will not be received until when? January 15th. So without the adjustment, Smart Touch Learning's financial statements would understate both an asset, accounts receivable, and a revenue of service revenue. The adjusting entry on December 31st records revenue earned for a half a month and also creates an accounts receivable. When Smart Touch Learning receives the payment on January 15th, the business will record cash received. Now notice that on January 15th, Smart Touch Learning records revenue only for the remaining half of the month. That's January 1st through January 15th. Only half of it. Okay? Smart Touch Learning recognized that $800 of the revenue was already recorded in December. The entry on January 15th removes the accounts receivable and records the remaining revenue. Now, if the business had incorrectly recorded $1,600 of service revenue on January 15th, the revenue would have been overstated in January. Here you see Exhibit F 3.3, Summary of Deferral and Accrual Adjustment. So the original entry and the corresponding adjusting entry is shown for the deferral adjustments. For example, the asset account, prepaid rent. Prepaid rent is a debit and cash is the credit in the original entry. When the rent is used, the prepaid rent account is adjusted with a credit, okay, which decreases the value of the asset. A debit to rent expense captures the usage of the building. Accrual entries do not have an original entry. They are adjustments for revenues earned but not yet collected and expenses incurred but not yet paid. So you see here that the exhibit is divided into two parts: deferrals, right, and accruals. In deferrals, the cash receipt or cash payment occurs first. In accruals, the cash receipt or cash payment occurs later. In case of deferrals, the original entry and adjusting entry. The original entry for prepaid expense, you'll see it there. Okay, so you have your deferrals and then you have your accruals. So the two rules to remember about adjusting entries is that adjusting entries never involve cash account. Adjusting entries either increase a revenue account or increase an expense account. Adjustments to the unadjusted trial balance are accomplished using adjusting entries. Mechanically, adjusting entries are similar other journal entries. First, the accounts to be adjusted are identified. Then a determination is made as to whether to debit or credit each account. Then the adjusting entry is created and posted to the general ledger. Here you see Exhibit F3-4. It is a summary of the adjusting entries that we discussed throughout the chapter. And the entries are from A to D. A-D are examples of deferred expenses. Items E is a deferred revenue adjustment. Entries F and G are accrued expenses, and H is accrued revenue. So again, A through D are deferred expenses. E is deferred revenue. F and G are accrued expenses, and H is accrued revenue. Here, this panel of Exhibit F3-4, it shows the T accounts and balances after posting. This exhibit also displays the panel 3, in which different T accounts with balances are represented in the form of the equation, the accounting equation, which is assets equal liabilities plus equity. You have your assets, liabilities, and equity. Here, assets is equal to liabilities plus equity. And there's your accounting equation. So this is actually the end of objective 3.3, where we discuss and explain the purpose of and journalize and post adjusting entries. Our next video will cover part 4 of chapter 3, which deals with learning objective 3.4, explain the purpose of and prepare an adjusted trial balance. So stay tuned for part 4. Thank you for watching. And please, if you haven't already, please click the subscribe button below.